Hi, Jim Yant of Golden Years Advisors, the home of the Kairos formula. Well, it's September 1st, and a lot has happened in the 30 days since we did our last State of the Market video update. We saw the market rally during that time, only to see significantly, only to see by mid-August, the S&P gave back about 8% of those gains, and NASDAQ even greater, about a 10% fall. And the reason for that decline is because the Federal Reserve is talking tougher and tougher hawkishly about raising rates, and that spooked markets. Markets said, So let's look at what the Fed said. Chairman Powell gave a speech at Jackson Hole, and I can literally summarize it in one statement, saying that interest rates will be higher for longer. Don't expect the Fed to get soft on raising rates anytime soon. And here's some of the quotes from Powell's speech: that the Federal Reserve is going to use our tools forcefully to bring demand and supply back into a better balance. And that's going to bring some pain, both to households as well as businesses. But a failure to restore price stability to fight inflation would mean even far greater pain. And in our bear case, we said that the Federal Reserve might mimic what Paul Volcker did back in the 80s when he raised rates really high to crush inflation. And Chair Powell quoted Volcker saying, inflation feeds upon itself. So part of the job of the Fed or the Fed chairman must be to break the grip of inflationary expectation. So the fear of higher rates for longer is the fear that we're already decelerating our growth and it's going to cause a recession. Some have argued that we're already in a recession. And we know why people are saying that for a couple of reasons. The Treasury yield curve has inverted, but more importantly, first quarter, second quarter GDP had negative numbers. And we've shared that there's something weird with the data. There's a mixed message coming. GDP has shown a contraction for the first two quarters, gross domestic product, but there's a second, actually more accurate measurement of the economy, GDI, gross domestic income, and it's showing the exact opposite. Red on this chart is GDP declining. Blue on that chart is GDI expanding. Usually over time, they have to be correct. So don't be surprised if you see GDP for first or second quarter get revised to an upward side. So we're not in a recession, we don't feel, because unemployment is still very low. It's in the mid threes. Usually it has to be approaching 5% unemployment before you get that. You also see, job hires happening, manufacturing expansions happening. So this just isn't a recession yet. Moreover, if this is a recession, why, from a revenue and an earnings perspective, is the S&P hitting all-time highs? If you look on this chart, the blue line, that's revenues per share, all-time high for the S&P 500, and the red line, all-time high for earnings. You might ask, well, why is the stock market falling then if we're hitting all-time highs in these important numbers? Simple reason is rates. When you raise rates up, it lowers the fair price of stocks, of any stock, but moreover, the entire index. And rates have moved dramatically. The Fed has moved in less than 6 months, 2.4%. And in the next 3 months, they're planning on getting the Fed funds rate to 3.4. So that's dramatically lowered the fair price or the value of the S&P. If we were to then say, well, what's that mean going forward? Well, so the Fed is fighting inflation by trying to slow both the economy as well as revenues, earnings, et cetera. If it's going to put a brakes on us, usually that slowdown is actually lagging. It takes about a year after you raise rates for those effects to happen. So let's just look at revenue, for example. Right above my head, if you look right there, that's the recession that occurred when we shut everything down for COVID, and revenues fell dramatically, 12% losses. The first red arrow that you see above, that's the second quarter last year, 2021, where revenue rebounded strongly at 22% gain. The next red arrow to the right, that's our current second quarter, which just ended. And if you see, it's still in the red box, a very strong and positive 12% growth. In any other time, we'd be happy to have that. So there is a slowdown, but still growth is occurring. That's the revenue picture. It's the exact same picture on earnings. Once again, I'll move out of the way, but a very steep drop during the COVID drop, a 33% drop in 2020, followed by the first arrow on the left, almost a 90% gain in earnings, a monstrous gain. Well, you can't sustain that, which is why to the right, the next couple of green bars are shrinking till you look at the Q2, the red arrow at Q2, where it's still a very nice, almost 10% earnings growth. And most times people would be glad to have that. But because it's decelerating, there's a lot of fear going forward. So what really is our second half economic forecast? Not ours, but the markets and economists in general. They always usually have a most likely case. That's what you're looking at from one of our economists we follow, Yardeni Research. They'll have a more optimistic and a more pessimistic one too. So on the most likely at the moment, what you really see is that blue bar is GDP, which declined. We said for the first two numbers, stay tuned to see where it's at. But then the red line going forward for the next 2 quarters is positive. If you look within the box chart, third quarter and fourth quarter GDP are expected to be positive. Another data point to get is the GDP Now website. The Federal Reserve Atlanta publishes every day on that website where they think the economy is. And if you look at it right now, it says a 1.6% growth in the third quarter. And here we are at the beginning of September. So economically, we're slowing, but still growing. What's that mean on a market or an earnings side? Well, here's an earnings forecast for the second half. And what we're comparing is that same economist, Yardeni Research, versus the consensus estimates of analysts. First column is the time periods, full year, and then quarter by quarter for the current year, and then 2023. The second column is where the target is, or the estimate. Black numbers mean actuals, and blue numbers mean estimates. So going forward, you see the blue numbers are the estimates of earnings, but I want you to focus on the third column, especially down in the last couple of blue numbers. Yardeni thinks that in the third and fourth quarters, we're going to see a slight contraction in the earnings numbers. If you skip over to the rightmost column, the consensus analysts also think there's a slowdown, but they think it remains positive. So where's the truth? Probably somewhere in the middle. Not a wipeout, not a deep reduction in earnings, but a mild. And just to go back one slide to remind you, 2 slides, to remind you, we've done that before. Just to give you an example, right in here, that was kind of what we would call a growth recession, where the earnings dipped, but they didn't go severely negative like you see to my left, any place where there's the deep blue bars. That's what a recession, a strong, deep recession is. So the analyst, that best case example is an earnings slowdown. Now, the bottom line, and no pun intended, but the bottom line of this chart is, look at the third column. Yardeni thinks it is a positive earnings outlook for next year. Likewise, fifth column to the right, the consensus analyst is the same. Not double digit, but strong single digit gains. What's that mean to your portfolio? Well, I said there's a fair value associated with any earnings that come. And this chart is them analyzing what's a fair value at what the current Fed rates are and where they target them. So if the Fed funds rate is somewhere in that 3.4-ish realm, that's what these bars represent. The right 2 sets of bars is next year, 2023, but where the blue line, which is the S&P, you'll see it's kind of trapped. The S&P has a bottom about 360, 3642 to be precise, and it's gotten up as high as just over 4,200. But that's about as rich as you would expect the price to be of the S&P, given this high of a rate and the current earnings, especially if they're shrinking back a bit, which is why we shared the comment, we don't see us hitting an all-time high this year. For that possibility to exist, you got to flash forward or go to the right to the next set of red bars where you see the bottom range is higher and the top range is higher. So that should give investors some hope and optimism as they go forward that we see a better tomorrow. What's this mean specifically within your portfolio? Well, within your portfolios in the golden years strategies, we're going to quality stocks, things that have earnings even during tough times. In the third party strategy, you see similar moves. So we hope, you have a great Labor Day. You might be not seeing this message till then, but we're going to keep our eye on the markets and our eye on your portfolios. Have a great day.